Good morning, ladies and gentlemen. Running through very quickly the US fixed income market for last week, we see that exactly what we said would happen has happened. The 5-year note has been in a very tight range and will probably remain so for another week. Between the 200-day moving average and the 50-day moving average and the 0.382 retracement, which comes in at 165 and probably not much higher than 182. So less than a 20 basis points trading range for the foreseeable future. 10 years are slightly more bullish, i.e. bearish in yield, bullish in price, but they're going to have a very tough time closing below 213. We think a close below 213 will be quite significant because it will indicate additional pressure for pushes towards and below 2% to around 190. The yield curve keeps on flattening, and especially in the 30 years, which can be seen here. This is a weekly chart and this is a 200 week moving average. We are at the lower end of the Bollinger Band, so maybe some move back towards let's call it 290 would not surprise, but we are certainly in a phase where we are at some stage going to test the 275 area in 30-year bonds. So overall the yield curve is still flattening. There are no signs of steepening and there are no signs of reflation. If we look at the commodities that we said we were going to look, they are still in a downtrend. There is absolutely no sign of these commodities turning up and even challenging close to the levels that we said we needed to break for them to signal any kind of reflation over the medium term. So commodities are dead to moving lower. Oil is moving lower, gold is moving lower, softs are moving lower. There is absolutely no inflation pressure, and in that environment it's unlikely that bonds are going to accelerate upwards in yield. Exactly the same thing is evident in Europe. This is the 5-year note, the bobble. As you can see, it closed right in the middle of the weekly channel. This is a weekly chart. The Bollinger Bands are between -55 and -25. So a 30 basis point range in which we can't even make a 10 to 15 basis point range during the course of the week. There is absolutely no reason to trade this until it starts trending. The 10-year is probably even more, the bund is even more compressed. We are basically trading in a 5 basis point range between -25 and -30, sorry, 25 and 30. Really no big ideas here. The only thing that is moving them is small yield curve fluctuations and fluctuations of periphery, i.e. Italy, France, etc., against the bund. With all the talk about the Germans wishing to end the QE of the ECB, there is precious little evidence that the market is taking them seriously at this point. If we look at what the dollar is doing, well, it's done exactly what we said it would do. 96.50 level, which has been here for months and months and months, huge support. It's bounced off the support. As we said, the 200-day moving average is still upward sloping. The market will be encouraged to trade around 98.40 or so, where we can buy some longer term options, hoping that this 200-day moving average is going to turn and the market is going to fall together with 5-year yields probably down towards the 145 level and here below 93. This 98.40 level is going to be very, very interesting. 98.40, 98.50. This is the level to put on some longer term options to hope for a rather larger move down in the dollar index. But we certainly think that we will trade 98.40. So from this 97 level we are, 98.40.50 should trade over the course of the next couple of weeks, and then we can have some more interesting trading levels to look at and options to buy. In equities, and this is a chart of the S&P, we are in an interesting situation because seasonally the week after OPEX in June has been almost always negative. The S&P keeps on doing nothing wrong. It keeps on having higher highs and higher lows. The trend lines are holding and the market is just there stepping upwards. We tried very hard to break the 24.20 level on numerous occasions in the past few days. Nothing has worked. There are no sellers. The market will probably just step higher, slowly going towards 2500. It is a market which basically has no sellers, just intraday sellers. The market keeps on rotating, i.e. different sectors keep on leading, but overall no money is leaving the market, and therefore the market just grinds higher. In volatility is very subdued. We're still not overbought in terms of volatility selling, and therefore we can't see very much hope for anything but a 2400 to 2455 range over the course of next week. Having very quickly run through the outrights, it'll be interesting to see what XLK is telling us at this moment. XLK we regard as the most important segment of the American market. It is what America is good at. It is software, it is high tech, it is all the goods that we associate with America, as opposed to everything else that everyone else makes as well. If you think about Europe, you think about Mercedes, you think about BMW, you think about chemicals. If you think about Japan, you think about robotics and so on. But if you think about the States, you actually think about Microsoft, you think about Apple, you think about XLK. This is a weekly chart of XLK against the SPY, so the ratio of change of XLK as opposed to the market itself. And as you can see that after the huge dump that we had in 2000 and 2000 up to 2003, the market has taken, well, nearly a decade and a half to slowly recover and start going up, which makes sense because XLK should be the strongest sector in the US market. We can see that this 0.2233 level has been very important in the past. We have been underneath it basically for 16 years, and we are now only just now beginning to break to the upside. This can be treated as a 16-17 year consolidation that we are finally breaking to the upside and starting to trend higher. This pullback has been the last few days of trading, so that is why we are interested in what this is telling us. If we now change this from a weekly chart, which I've shown you to get some perspective, to a daily chart, the picture starts getting even more interesting. And here is the daily chart. the red line is the 200-day moving average. This is that very important level that we saw on the weeklies, and these are trend lines that the market has been trading within for the past several years. In fact, this goes back to '08, and since '08 the market has basically been in a steady uptrend in terms of XLK over SPY. This is why we are so interested in these levels. We have this area we think is going to be an excellent buy over the course of the next few weeks. We are very close to it. We could get there within certainly the next week if there's any further weakness in NQ. This level matches certain different levels in XLI as well, which will be very, very interesting. So we will be watching this level very, very closely and buying XLK when we get there. We are probably 1 to 1.5% away in a move by NQ lower to get XLK to this level. So we are quite close. I mean, this is basically a day's worth of trading. It is quite actually significant that over the past few days we haven't been able at all to rally in I mean, we see this massive dump in XLK last week, and we actually haven't been able to retrace at all, which basically means to us that we will test at some stage next week these levels, and those will be very interesting, very long-term holds. If we look at XLK over XLF, so the technology over the financials, we see that they are actually in a very, very gradual uptrend. This is a chart going all the way back to '08, and we can see that we haven't challenged even the levels that XLF over XLK was in 2011. This is basically the recovery in the banks when tech did very little. Then we had more recovery, and now we are still stuck within this range that it has been trading in for the past 10 years. So we think it's time that XLK should start accelerating against the banks, because it makes absolutely no fundamental sense to us that XLF and XLK should be so tightly trading for such a long time. XLK should be breaking out against XLF very violently at some stage soon. And another very interesting chart is XLK, so technology over XLI industrials. You would have thought that this spread had moved out hugely over the past 10 years, when in fact not so. This is 2009, and basically we are still in the range that we traded between 2009 and 2017. We are in the same range that we have been trading for the past 10-15 years. That is quite remarkable. While everybody thinks that we have had a huge explosion in tech prices, this chart actually tells you that we have not. We have had a very steady as she goes relationship between, say, call it 84 and 72. That's a 12% trading range in the spread between XLK and XLI. So basically industrials or the technology have been outperforming or underperforming each other by a few percentage points a year, but overall we haven't even moved 12% in 15 years. That is less than 1% per year. You would have thought that a contract, I mean, or an ETF which offers technology as opposed to boring industrials in the United States would return far more than 1% per year, because certainly the risk is far higher than 1% per year. So we certainly think that the price having returned to the 200-day moving average, but it often spikes it, as you can see from these other periods in history. That is why we're still waiting to buy XLK, as per the other charts we've shown you. We certainly think that XLK is now undervalued, and listen to this, undervalued against XLI, against XLF, and against the SPY. So we are looking for these levels to put on large trades in favor of XLK. The final spread chart that we think is very important here is ACWI, which is basically the world index of stocks against SPY. We think we have now terminated this basically decade-long downtrend in which the market has been favoring SPY against world stocks. The SPY is now very much more expensive in terms of valuations than the world stocks, and the world stocks, and we will now show you also EEM, which it has a very similar formation. It is very interesting that it continues to consolidate at this level before it breaks the 0.2742 level, which has been so important over the past couple of years. We will now try to have a closer look at what is going on. You can see how many times this 0.27415 level has been touched and rejected by the market. Therefore, we think that any close above it is going to be extremely important over the course of the next few weeks. And here is EM, so emerging markets over SPY. We are still waiting for this famous break above these lines that would suggest to us that the market is in full trend. The 200-day moving average has flattened out completely, so it might indicate that we need several more weeks of price action above the 200-day moving average before a break becomes sustainable and before the moving average can turn. So it is still very dangerous to buy at this stage, and it is probably suggesting that we'll trade up and down for a few more weeks. But we think that the whole market here is trading very well in this uptrend. It might break it. It is not conclusive here, but all we know is that when the market finally breaks to the upside, it'll be a very, very rapid move and will be a very, very profitable move, and therefore it's important that we have these levels in mind and that we have alerts set up for them, so we do not miss when these relationships starts breaking down to the upside, and therefore indicate a big change in trend for the emerging markets and for the world index against the American market. Out of the 50 or so risk on risk off relationship that we follow, the only one which is flashing anything but sort of amber or green, i.e. red, is HYG, which is junk bonds over TLT, which is the 20 to 30 year treasuries. It is the only market which is breaking significant levels, and it's also broken a steep upwardly sloping 200-day moving average. So the market probably won't go too far away from here because it'll retest the moving average from below a few times. but it's the one market which has this rounding top and is basically telling us that anything which is not good credit is beginning to get into trouble. So this market is telling us get out of speculative things and get to some safety in treasuries. It is the only market which is telling us that equities are beginning to walk on thin air, but it's also a market which is telling us that nothing much is going to happen very quickly with that respect. So there is no need to take action immediately. It's just a very long-term warning sign that some relationships are finally beginning to break down in terms of credit. It is probably a warning that oil will continue to break to the downside, and therefore that bonds have less downside than people think because of this flight to quality and the demand that will generate for bonds over junk. So this is a market which tells us do not short quality bonds and do not buy things like oil or energy related products because they might be very much in trouble. Well, the biases for next week haven't changed very much. We still think that 119.03 and 126.30 are very important in 5 and 10-year notes. Until the market does something there, we are not very interested. Bunds and bobbles, same thing. There is no inflation, you can forget about it. And ES, basically, it is doing very little. And what we wrote several weeks ago, that we would not be surprised by a 3 to 4% range for several months, we think holds. We have the closes in XLF above 2370 and 2410. Therefore, XLF is likely to trade up towards 25 and support ES over, the next several weeks. NQ, we will be buying it when the XLK, XLI, XLF, SPY charts align. We think that will be a big move, certainly 5 to 10% on the upside in terms of NQ against everything else. And the Russell, we think that 1383 is the extremely important level, and we will watch that. We are bullish above it and bearish below it. The super cycle that we are predicting still seems to hold. We showed you EEM and we showed you the world index ACWI. We think that those will continue to go up, but less so against XLK. European equities we still think you have to buy the dip because there's still more liquidity coming by the ECB. The liquidity might be about to evaporate in the States, but it will stay in Europe for quite some time. And EM and ACWI, we still think that longer term you have to hold them. You might get choppy in the short term, but longer term you have to be long. And DX, we're looking for this bounce towards the 99 area, probably no higher than 98.50, where we can take on some option positions betting against the dollar. Thank you very much indeed, and tweet you on Monday.